Hey all, welcome back to Howieverse. Today we're going to discuss housing bubble. Is the US housing market in bubble right now? The answer is no, according to data. But why does it feel like we are in housing bubble right now? That is due to the house affordability. So let's look at the data. In this chart right here, the median house price back 10 years ago in 2015 is $289,000. Fast forward to today, the house price is $410,000. That is about 40% increase in house price. To make it worse, the median salary in the US today is only $61,000. So if you divide that house price divided by the annual income is 6.6x. So that means your house is 6.6 times more expensive than your annual income. To make the matter worse, this is the average of the US, right? If you live in a higher tax rate state, for example, like California, you only making about $70,000. However, the house price over there is a lot higher than the median house in the US. If you live in New York, for example, that is even worse. And here in DC is actually give you the highest salary. However, over at the DC area, the housing price is actually really high as well. So in this case, your multiplier, the ratio between your house price and the annual salary is gonna become higher depending on where you are geographically. So this is the chart format of house price to median household income ratio. So back in the housing bubble, the ratio is at 6.74. Fast forward to today, it is above 7. You might think that, hey, this ratio is above 7. Back in the housing bubble was 6.74. We must be in a bubble right now. However, I would like to tell you that this is only one data point where we can refer to. There are other things that we need to consider, for example, like demand of the housing, the supply of the housing. Those are the two main factors that we need to look into. However, there's no denying that the house price has become really, really expensive in comparison of what you're making per year. The other thing that I would like to show you is how expensive the mortgage is if you want to buy a house, assuming that you don't have the full amount to pay down the house, then you have to take out the loan, right? So the house price, if you remember back in the first that we saw at $410,000, and if you have the down payment of $82,000, if you can even save up that much, right? Let alone that 5% is already that expensive. And let's just say you have the loan term at 30 years, the interest rate at 6.3. That's assuming that you have a really good credit nowadays, that the zip code doesn't really do anything here. Property tax around 1% of the house price, and that is taking account per month. So that's divided by 12, it's 350 per month, and you need to pay insurance. Homeowner insurance is about $100 per month. Since you put 20% down, the PMI is 0, and let's just assume that you have HOA, right? And your house payment per month is $2,540, and that is including the principal interest, which is around $2,000, property tax, homeowner insurance, and everything else. What's crazy here is if you look at this amortization of the loan, the actual loan amount is $328,000 that you already put in the 20% down. But the total interest that you pay over the 30 years is more than $400,000. So more than half of what you pay every single month for 30 years is actually go to the total interest payment. And this is what I believe, that when people see this, they kind of like, oh, the interest rate is really high. Half of the amount of my money is going to just go to the bank and help bank become richer. So they're like, no, thank you. So basically, what I am thinking is that a lot of people are actually sitting on the sideline because the interest rate is really expensive right now. Not only the interest rate is expensive, however, you need to make at least $75,000 to be able to afford the house. Let me explain. So, remember when I said that the house was 25, where is it? So $2,500 per month that you have to pay, and you need to make $75,000 for you to be able to take home about $5,077, and half of that goes to your mortgage, right? So half of 5,000 is about 2,500, which is going to your mortgage, and that is your take home salary after you pay the tax, after you pay the social security, right? That's $5,000, and half of that just goes to your mortgage, and that is really expensive. So if you notice that this is $75,000 per year that you have to make, and if you notice back in the median salary in the US is $61,000 or $62,000, give or take, right? And in order for you to afford the house where 50% of your paycheck is going through the mortgage after paying tax and social security, you have to make $75,000. So more than median income salary in the US, more people are not going to be able to afford the house due to this reason, where they need higher salary to be able to afford mortgage. Also, mind you, the calculation that we performed before was actually in Nevada. And if you are in San Jose, California, you have to make at least $82,000 per year, right? To be able to afford that 2,500 mortgage where your house that is bought in Nebraska. Jokes aside, right? So if you're making $82,000 and you want to buy a house in San Jose, California, it's not going to be $410,000. So it's gonna be like $1 million, right? So you update that, that would be $5,000, and let's just do the math real quick. I think you might need 258,000. Nope, not really. More than that. It's gonna be 200. Yep, it's gonna be, you're gonna have to make $200,000 to afford $1 million house with 20,000 down payment to be able to buy a house in San Jose, California. So good luck. Lastly, what I want to show you here is this article from Business Insider. It says, when will the housing market crash? Economists don't foresee it in 2025. And the expert overwhelmingly say that the housing market isn't going to crash anytime soon. This is due to the lack of supply, which helps um, the housing from price to fall down. And also the mortgage rate, however, may ease in 2025, which is true. The Fed has already been cutting several times. However, it's not enough. Soon to become in 2026. And this is going to help making home ownership more affordable, right? And if we scroll down, the challenging housing market has many would-be buyers wondering if the house price will ever go down or if they might crash in the near future. And I do not foresee this is going to likely happen, where the house price is going to go up even in 2025 and also 2026. I'm not sure in 2027. However, in the near foreseeable future, it is highly not likely. And the Fannie Mae estimate that home price will increase 4.1% in 2025 and 2% in 2026, which is aligned with what we are saying earlier, right? And also the home sales is also going to increase by 2.5% in 2025 after ending in 2024 down by 0.2%. So home sales is going to increase 2.5% in 2025. And in the latest summary of economic projection released in March, Federal Reserve officially predicted that the unemployment rate could take up to 4.4% in this year before inching back down to 4.2% over the longer run. However, I would like to tell you that yes, the unemployment rate could be a risk for housing market. However, this is not likely to happen anytime soon. I believe currently the Fed has already reached that maximum employment where they want it to be, and also the Fed has the rate to play with, right? So the rate is not entirely zero now. I think it's around like 4% or something like that. So the Fed can bring that down lower in the hope of making the job market going back up. And currently the unemployment rate is seeing a tick down, but it's not a huge red flag yet. And then later on, it says, are we in a housing bubble? A housing bubble happens when the house price rise rapidly over a short period of time due to an unsustainable rise in demand. I don't think the demand is unsustainable. I believe there is still a lot of pent up demand where the people would like to buy a house, but they can't. And it's further say some people think our current market is a bubble because house price has gone up so much in the last few years. So this is actually what we're talking about the in the beginning of the video, where the house price has gone up so much and people are thinking that the housing is in a bubble. But the key is to housing bubble is that it's not rooted in the fundamentals of what typically drive the house value, right? So the price have gone up so much in recent year because the home buyer demand surge when the mortgage rate drops to historic low in 2020 and 2021. However, here's the key here. It says here the supply remain tight. So there's not enough supply to support everyone who wants a house nowadays, right? And let's see further. This is different in 2008, right? The lack of mortgage lending standard back in the day, they just give everyone the mortgage that they see. Every living person, they giving out mortgage, and this is artificially drove up the demand in a very short term, and that is unsustainable. Back in the 2008, that is really unsustainable due to this many demand where eventually, when the housing bubble burst, many homeowners found themselves underwater, cannot sustain the mortgage, cannot pay the mortgage, and therefore there are a lot of foreclosure, and that essentially takes the housing market down. And for nowadays, the lending standards are a lot tighter now, and homeowners have a lot of equity in their homes to cushion them from the impact for the housing bubble. So a lot of people nowadays have a lot of equity. Because they have a lot of equity, they are not forced to sell if the price coming down where they cannot pay the mortgage, right? So when they lose their job, they are not going to be panicking because they have a lot of the equity inside the house, right? So if we look at the data here that I wrote down, 42% of homeowners have no mortgage. So 42% of homeowners own 100% of their house. So even though in the situation where they lose their job, they are not going to panic and sell the house at a loss or even underwater, right? Or giving it back to the bank. And that is not going to make the supply surge up in a really short period of time. And thus, the house market is not going to plummet so fast. And also, the second point here is 72% of homeowners who do have mortgages have 4% interest or lower. So previously in the calculator that we put in, I think 6.5% interest rate, and a lot of the homeowners in this case, more than half is they have 4% or lower interest rate. So they meaning that their mortgage is going to be lower than what you're going to pay today. As a matter of fact, a lot lower. So even though, as I said, I'm gonna sound like a broken radio, but it needs to be said again that in the case of the job market or the employment take up, they're not going to be forced to sell the house because they have a relatively cheap mortgage comparison to nowadays. And if we look lower, the US is between 2.3 million and 6.5 million units short of a healthy housing supply, according to realtor.com. So, what it means is that it's just propagating the saying that there is not enough housing to healthy housing supply, healthy housing to support all of the people who want to buy a house, right? In conclusion, the US is currently not in the housing bubble. Despite of the house unaffordability right now, house price is really expensive due to the pent up demand that people wants to buy a house and there is not enough supply to sustain the demand. So high demand, low supply equal to no housing crash. However, I'm interested in your thoughts whether the house price is going to be lower or higher in 2026. Let me know in the comment down below. I'll see you in the next one.